Per usual, on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's talk about flows for a little bit, everyone's favorite topic. We found out today, as many of us suspected, the FTX estate sold about $1 billion in GBTC. That accounts for 2 days of outflows. I'm guessing they had to sell that over a week or something. And it took a while, right? So one of the 4 sellers out of the equation, which is good news. It's good to know that. It's good to take them off the big board. But the other question people are asking is, okay, who is left? Do we know who's left? No, we don't know who's left. As far as the 4 sellers are concerned, you have the tax advantaged accounts that are clearly getting out of GBTC for anything cheaper. And because it's a cash settlement, every single SAT that gets sold out of GBTC has to hit the market. And you have to ask yourself, what are the order of operations here? Everyone is looking at this completely backwards. If throughout the day, it feels as though somebody is selling a substantial amount, it's probably GBTC. Just assume it's GBTC. Okay. So if by the end of the day, we're down 5% or whatever, probably GBTC. Next step, end of day, what is the reported outflows from GBTC in notional value, dollars amount? Okay, it's going to be probably another 500 million clip today. Then 2 days later, we will see the on-chain flows. The on-chain flows you're seeing today are from last week, okay? People have this so backwards. They might finally figure it out once this is all done, but the most important thing here is price. I hope that's clear. I hope that's obvious. Anyway, so how much do they have left to sell? Realistically, I don't think they get past 50% in the near term. I think the sweet spot in the near term is probably going to be 20 to 30% of the trust that has quick outflows. But we don't know, right? So look, keep in mind, this could go on for quite some time, and it's probably not going to get drained to zero from launch, but certainly doesn't look super pretty right now as we're fighting at 40K. The good news is the non-GBTC ETFs are slowly growing here, and eventually, over time, will eclipse GBTC. It's only a matter of time, so keep that in mind. Here's the James Butterfill flows report, and shockingly, I say that with great sarcasm, we have a net outflow last week. This is global products. This is all products, including non-Bitcoin products. There was a lot of churn. There's a lot of shuffling of stuff going on right now. Until this slows down, this is all that matters. Obviously, I hope people have figured that out by now. If price is down 5% in a day, it's grayscale. If at the end of the day we have 500 million in outflows, expect another 500 million tomorrow. If we don't get it, then we can celebrate. Expect price to keep going down until it doesn't. But you clearly see some of this moving its way through the system into the cheaper vehicles. We had outflows from Ethereum, outflows from Solana, inflows into the short Bitcoin ETF, and some inflows into the multi-asset products globally, outflows with United States getting the lion's share of inflows there. One other thing I want to talk about. So Crowded Market Report, Jason Shapiro puts these out. This is a paid service. It's based off the positioning data of the CME futures, which is free, but his graphs are paid. Anyway, this is not an advertisement for his service, but he has a free newsletter now as well. And he sent these out yesterday. The TLDR and how to read this is as follows. He likes to side with the commercials and to side against the large and small speculators. So the most bullish positioning he would look for would be a very small yellow bar, very positive red bars, and very negative blue bars. You can see the previous period, last quarter, right? We had commercials flip. He calls that the turn from negative to positive. We had retail actually come off a bit here, and we had large spec get shorter. Okay, this is exactly the type of environment you see based on his 20 plus years of data for all markets that he looks at this stuff for a bullish type of market condition. We're now seeing commercials, the red bar, drop to zero, slightly negative. We're seeing large spec shorts come off a little bit, and then retail. Retail's kind of irrelevant in crypto, in my opinion. Retail's never going to quite go to zero. You can see April, May 2022, the yellow bars here, retail went flat. But Retail's still fairly long, large spec still fairly short, but closing and commercials are on the wrong side. So this is not a favorable condition for bullish market conditions. It just isn't. I mean, that's hopefully obvious as you're seeing price collapse. And here's the zoomed out view. Of course you can look at this against price, but this is just one more thing based on the positioning data that says, hey, now is not the time to be long. And here's the data on TradingView with price. And you can see again that flip at 28K was in alignment with commercials flipping long and large speculators flipping extremely short. Similar occasion at the beginning of 2023. So this is, again, is not a place to be long Bitcoin. He also has data on ETH. ETH slightly different here. Retail extremely long, commercials somewhat long, large spec extremely short. So it's actually more favorable on the ETH side based on the positioning data for longs at this point in time. ETH has less total data over time, but this is still one of the better looking periods of time based on positioning data. He would probably argue you want retail less long. This is kind of an extreme long. If you think of this as an index from 0 to 100% or max long, right? They're 70% historically. So retail's fairly long. Anyway, ETH is a better setup based on positioning. Once again, we can see when this positioning stuff flips, most obviously, again, January 2023, November 2023. You can see we had some of that in June, July 2023. So it's just helpful to know where this stuff's at. TLDR, ETH looks better from the positioning standpoint. Talked about this yesterday, but real quick, again, this is an obvious potential short setup as we're much lower than when I made this chart a few hours ago. But we are in the cloud now, and if we close inside of the cloud, that would be another short entry signal, a bearish edge-to-edge trade. The 20-week is down there at 36. The cloud's down there at 35. Yearly pivot at 34 and change. And then ultimately, the 200-week is at 30 and change if we get super angry. And if we zoom out a little bit, in 2023, we had several taps of both the bottom of the cloud and or the 200-week moving average. The biggest and best move we got was based on breaking above all of it, right, at 28K, which is another reason why 28K was such a big deal at that time. So this is the best long trade. Anything in here, right, you're guessing when GBTC outflows stop. You're hoping that you catch a knife. I hope everyone makes all the money. I'm just saying, look, there's plenty of reasons why now's not the time to be on the long side for Bitcoin. All right, let's talk about macro now. Not much as far as data this week. We've got PCE at the end of the week. And again, for me, not much else that's super important. Q4 GDP, preliminary, sure. Truflation's come down sub 2% now, and it's been holding sub 2%. And this is where things start to get interesting, because how restrictive does the Fed want to be? Again, somebody please ask him that at the next press conference. Where do you want to be, and what are we looking at here? Okay, you've got 10,000 metrics to choose from. Pick 5 out of a hat. Just let us know. What levels are you looking for to cut rates? Or do you just want to remain restrictive? They're going to say employment's fine and we don't want inflation to come back. Okay, but there's a tipping point here where if we remain overly restrictive relative to inflation, year-over-year inflation, not, purchasing power. Purchasing power is wrecked, okay? But inflation, if this dips much lower, it almost guarantees a reaction from the economy. So this is part of the whole soft landing narrative, right? We got to do our best to navigate in and around that. The rent stuff has come way down. Now, this is lagging. I don't know why they use a lagging component still in CPI, but whatever. Eventually, this is going to work its way through the system. This is a massive drop in new tenant rents prices. So next month's CPI print for this month is projected to be slightly under 3%. The last CPI was 3.4%. To me, that would qualify as good news, which the market may not like, because that may mean higher for longer. But again, it depends on how restrictive does the Fed want to be here. PCE trend as well is headed in the right direction. Again, we're getting a PCE print this week, so we'll know more on that front. But based on the metrics that people think the Fed cares about, we look pretty good all around to just start cutting based on being overly restrictive. The next CPI print is Valentine's Day, February 13th. That is after the next Fed meeting, which is at the end of this month. And then the next Fed meeting isn't until March 20th, right? So there's a lot of time between those dates for the Fed to figure out what the heck they're going to do here. Likely we get some cutting in the middle of the year, just based on being overly restrictive. That'd be my guess. The other components of inflation, gas prices have remained flat and down. If you look at US oil on the bottom panel here, technical's starting to curl up a little bit. You could say Middle East stuff. You could say OPEC cuts finally taking effect. There's an inverted head and shoulders argument here. There's a edge to edge argument from 76 to 81 or whatever that is. The top here is the SPR, which we're slowly but surely refilling. I'm zoomed way in because you have to. If you zoom out, we have long ways to go to fill this thing up. Okay, but we are filling it up. So that's that. Another interesting stat, talking about EVs, which seem to be all the rage. It's certainly cheaper to fill your car if you're an EV, but it's the other concerns. It's the other repair costs, the upfront costs, charging anxiety, dealing with cold weather, warm weather, that sort of thing. I think we'll get there as a society eventually, but in the moment, especially, dealing with the weather events we've been dealing with, if you need to have a car and you have an EV recently, it's been an issue for you to get around in this extremely cold weather. Used vehicle index continues to turn down here. You can see the pre-pandemic trend. We've got a long ways to go, but this should mean cheaper car prices eventually across the board. Just taking its sweet old time to get there. The biggest inflation argument recently, which all of the doomers have lashed onto, has been the Suez Canal issues, which have basically brought trade through that region to a grinding halt. Now there's still some shipping going through there, but it's much less as a percentage. And yeah, that's not going to help inflation, but I don't see that as being a major issue in the super near term for inflation. Reverse repo continues to get drained as expected. The quarterly refunding announcement is also at the end of the month. So that may be a bigger deal than the FOMC meeting, where the Treasury comes out and says, this is how much we're going to issue in debt in the upcoming quarter. And that should really be the final nail on the coffin for killing reverse repo completely by the end of the quarter. This should be drained to some level that makes sense, potentially zero, potentially slightly higher. And then after that, as we issue debt, yields likely creep up unless something else is done to absorb that debt. Putting it all together, if we look at S&P, BTC, reverse repo, junk bonds, and the euro, everything that kind of has correlated together, reverse repo in the inverse axis here. As long as there is reverse repo to drain, yields probably go higher slower, which helps everything else go higher on the risk side. But the moment yields go higher in a big way, that eventually will have a negative effect on risk. So there's still a remaining window until the Fed does something, until something changes, either on the debt side or on the Fed side, where risk can continue to do well. That window is closing very rapidly, though. We also have this, shenanigans with the BTFP that they're going to be closing, where it's to a bank's advantage to utilize the BTFP to basically arb the rate, which is a joke. That's definitely not why the BTFP was created. So that's another question I hope they ask Powell at the press conference. Hey, you created this for X and it's not being used for that. You've said you're going to close it in March. Is that definitely what's going to happen? I'd love for someone to ask him that. As far as rate probabilities, still pricing in 6 cuts this year. Sure. I'd believe any argument. 6 cuts, no cuts, 3 cuts, whatever the Fed wants to do from a being restrictive perspective, right? If they think we're not restrictive enough, hold the rates. If we look at a Bloomberg Financial Conditions Index, we are extremely unrestrictive. We are the opposite of restrictive here. So again, it just depends what 5 metrics do they want to look at and tell us about. I think once the RRP runs out, this will flip to being restrictive. But until then, we are still extremely non-restrictive. GDP continues to look good. So again, doomers, sorry. Just, look, I know you don't believe the data is real anyway, but GDP looks great. Jobs looks great. From the numbers perspective, not much else to say on that point. I mean, everything's super positive. Commercial real estate continues to be a problem. Odd to see Detroit at the top of the list as far as vacancies. I've been hearing more issues about DC. I think all that's going to start to come to a head here this year. We seem to see a headline a week, X location was sold at 50% of what it was last purchased for. Nobody can fill these buildings. Nobody wants to go back to the office. Definitely not full time. So I don't see this changing anytime soon. And I don't think anybody listening to this video wants to go back to the office either. If we look at the dollar, DXY, first thing that popped out to me was the potential for a inverted head and shoulders here through the daily cloud. It's pulled up quite a bit now off of the lower inverted head and shoulders bounce. So any dollar strength is not going to help risk in the near term. Ultimately, I don't think DXY moves in a big way until the Fed actually cuts rates, if they cut rates. Until then, we're probably just range bound between 100 and 106, I'd imagine. Into Bitcoin halving, we likely do see cuts, and that's likely when we see the Dixie go lower. Last week I was talking about the potential for another failed inverted head and shoulders. That didn't happen. DXY broke up and still not quite hitting the target of 104 plus. So DXY still looks pretty strong. As far as the indices go, S&P, the Qs, they're at all-time highs. They do have bear divs. I don't expect too much here. I think everybody still feels better if there's some sort of pullback first in a bigger way. Maybe a lower low, trap the bears, retest the horizontal breakout level, and then keep going from there. But it's tough to push like this when you're already kind of running out of steam. Not impossible, but typically when you see continuous all-time highs, right, there's some sort of a momentum push like there was in 2020 and 2021. We just don't seem to feel like we have that at the moment, broadly. One other thing I saw the Doomers talk about last week, did you know before 2008, there was an all-time high? Yeah, and so Ryan, as always with great data here, yes, 10 times an all-time high was the peak before a new bear market started. But if you thought that every time there was an all-time high, you'd be a poor person. That's basically what he's saying. So the trend very much is clearly higher and not, expect this to be a bear market. Okay, that should not be your base expectation. The Qs here, again, bear div, probably pull back a little deeper below 400 at some point, but I definitely like 500 eventually within the year. If we look at the Mag 7, one of these really sticks out like a sore thumb. I guess this isn't Mag 7, this is 8, but tech stuff looks great. Apple has even recovered. Microsoft all-time high, Nvidia all-time high, Google close to all-time high, Meta at or near all-time high, Netflix great recovery, Amazon still looks great to me. Tesla does not look like everything else. Tesla looks more and more bearish. I know they have earnings coming up, whatever. This does not look like a bullish chart to me at all. Below the 200-week moving average, below the weekly cloud, below the yearly pivot. Nice little head and shoulders, triple top. I don't know. It just doesn't look bullish to me. I know a lot of people trade Tesla and pay attention to it. I don't know why. There are infinitely other options to trade here. From a technical perspective, I just don't think Tesla's the one. Here's an example. Somebody brought up today on my Discord, Twilio. This is the wrong cloud, but whatever. Ascending triangle, looks a lot like Square, has a massive cloud setup here. Will it play out? I don't know, but it looks great. And if the Fed does cut, it's charts that look like this that probably do well into 2025. This is the exact bullish TK cross, price closing in the cloud. I'd rather trade this than anything in crypto right now. Okay, this looks great relative to anything in crypto. So there's plenty of other stuff out there. Don't force yourself to trade Tesla or some other junk when it just doesn't look good. Crypto included. And this is Square. Looks very much the same, crypto adjacent. Almost ready for that bullish edge to edge entry there. Tends to do well after halving for Bitcoin. Still looks good. That's a 2024 setup. The issue with trading some of legacy as we get to the end here, if you pair this against Bitcoin, it's a really hard sell to sit in anything relative to Bitcoin over time. So this is Square relative to Bitcoin. Prices going down means Bitcoin gaining on Square. This is coin against Bitcoin. Range bound, maybe inverted head and shoulders, but I would have to see some super compelling evidence to say, okay, yeah, let me sell most or all of my Bitcoin to trade coin or MSTR or any of this other junk, especially now as the ETFs are here. You better believe people are going to be comparing the pure play relative to the company or the beta or, some adjacent crypto product. So not a super strong argument, even for coin, for Marathon, kind of the same thing. You can easily set on an alert at these levels and just make a decision, but still fairly favorable to just sit in Bitcoin, from my opinion, at least in the moment. This is QQQ against Bitcoin, right? Not a strong argument for a bullish trend on this pair. And one of the only charts, if you go out to the very extremes, if you look at NVIDIA relative to Bitcoin, over the years, this has certainly proven to be a better trade. But we're still in this decade-long range, arguably, right? Post-halving, Bitcoin tends to do better than NVIDIA historically. We'll see if that happens again. But just to get people thinking, I see more people trading everything these days, and I think more people are going to be trading even more of everything now that ETFs are here and there's going to be trading focused in the ETFs. So don't be afraid to do these pair analyses on stonks versus BTC. Lastly, this is gold. Nothing new here. Flat, right? Ain't nothing going on with gold. Not much to do. And then gold versus BTC is a joke. Again, why? This is another great example of why we've got people paying too much attention to gold, not enough attention to Bitcoin, and another great argument for the digital gold conversation. So that's all I have for this one today. Voice still trying to recover here. Like, dislike, comment, share, subscribe, and happy trading.